China's largest chip maker just tripled its quarterly profit. SMIC reported second quarter profit of $479.2 million, more than 3 times the level from a year earlier and almost twice what analysts expected. Revenue climbed 36% to more than $3 billion, while factory utilization reached 93.7%. The surprising part is that SMIC is achieving this while facing some of the toughest technology restrictions in the semiconductor industry. The United States has spent years limiting China's access to advanced chip-making equipment. SMIC itself has been on a U.S. trade restriction list since 2020, and Chinese manufacturers still lack access to the most advanced extreme ultraviolet lithography machines used by global leaders such as TSMC. So how is a company that remains behind the global frontier suddenly growing this fast? The answer is that the AI boom is creating shortages far beyond the most advanced AI processors. And SMIC does not need to beat TSMC at 2-nanometer Fanjuric to profit from that. When people think about artificial intelligence chips, they usually think about NVIDIA GPUs or the advanced processors being designed by Google, Amazon, Huawei, and other technology companies. But those chips cannot operate alone. An AI server also needs power management chips, networking controllers, display and interface components, sensors, memory support chips, microcontrollers, analog processors, and countless other semiconductors. Many of these components do not require the newest manufacturing technology. A power management chip may work perfectly well on an older production node. The same is true for many microcontrollers, display drivers, image sensors, connectivity chips, and industrial semiconductors. This is where SMIC has enormous capacity. The company manufactures chips across a wide range of established process technologies, including what the industry calls mature nodes, and those mature nodes are becoming unexpectedly valuable. Here is why. Global semiconductor companies are directing more investment toward high-margin AI products. Advanced factories, memory suppliers, packaging companies, and equipment manufacturers are all trying to capture the AI boom, but production capacity is finite. When more resources flow toward advanced AI chips, other parts of the semiconductor supply chain can become tight. The result is a strange spillover effect. AI does not only increase demand for AI chips, it can reduce available supply for ordinary chips. That pushes customers toward foundries with spare mature node capacity. SMIC says it is seeing exactly that. The company expects AI-related demand to remain strong through the second half of the year and is accelerating new production lines to address supply constraints. Only 2 years ago, the situation looked very different. SMIC warned that the semiconductor industry was suffering from significant overcapacity. Its co-CEO said industry utilization rates were hovering around 70%, well below what he considered an optimal level. Today, SMIC's own utilization rate is above 93%. That changes the economics dramatically. A semiconductor factory is extremely expensive, whether it is full or empty. The building exists, the equipment must be maintained, workers still need salaries. Depreciation continues. But once more wafers move through the same factory, those fixed costs are spread across more products. Imagine a factory costs $100 million a year to operate before producing a single chip. If it produces 1 million wafers, the fixed cost is $100 per wafer. If it produces 2 million, the fixed cost falls to $50 per wafer. That is why utilization matters so much. SMIC's gross margin reached 25.3% in the latest quarter, significantly higher than its own previous guidance of 20 to 22%. For the third quarter, it expects gross margin to rise further to between 26 and 28%. More demand is not simply increasing revenue, it is making each factory more profitable. This also explains why SMIC continues expanding aggressively. Earlier this year, management said the company planned to add around 40,000 12-inch equivalent wafers of monthly capacity during 2026, after adding another 50,000 wafers of monthly capacity in 2025. That is a major investment. But unlike several years ago when investors worried China might be building too many semiconductor factories, SMIC is now adding capacity while customers are already struggling to secure supply. This reduces one of the biggest risks in chip manufacturing. The company is not building only for hypothetical future demand. It is responding to factories that are already running close to full capacity. But there is a deeper reason SMIC matters. China wants semiconductor independence. For years, Chinese electronics companies relied heavily on foreign manufacturers and imported chips. U.S. export restrictions changed the incentives. Chinese companies now have a strategic reason to use domestic suppliers even when foreign alternatives might be technically superior. That gives SMIC a protected source of demand. A Chinese smartphone company, automaker, industrial equipment manufacturer, or AI company does not only care about price and performance anymore. It also cares about whether its supply can suddenly disappear because of export restrictions. Domestic manufacturing becomes insurance. This does not mean SMIC has eliminated China's technology gap. Far from it. Tech Insights reported last year that Huawei's MateBook Fold still used a 7nm equivalent chip manufactured by SMIC rather than the newer 5nm class process many observers had expected. The research firm concluded that U.S. restrictions were continuing to slow SMIC's progress toward more advanced production. Global leaders are moving toward 2nm technology. SMIC remains several generations behind at the cutting edge. That gap matters enormously for frontier AI accelerators. Advanced processors become more powerful and energy efficient when more transistors can be packed into a smaller area. Without access to EUV lithography, SMIC must rely on more complicated manufacturing techniques such as repeated patterning. That increases cost. It reduces manufacturing yield, and it makes scaling advanced chips much harder. This is why SMIC's current success is so interesting. It is not winning because the restrictions disappeared. It is winning despite them. The company has found a part of the market where being behind the technological frontier matters less. For many chips, reliable manufacturing capacity is more important than having the smallest transistor. A car does not need every semiconductor inside it to be manufactured using the latest process. Neither does a smartphone, neither does an AI data center. This creates a two-speed semiconductor market. At the frontier, companies such as TSMC compete to manufacture the most advanced AI and computing chips in the world. Behind that frontier sits an enormous market for everything else. SMIC can make billions serving that second market while simultaneously trying to improve its advanced capabilities. And AI may actually make the second market more valuable. There is another factor helping SMIC. Customers are becoming more cautious about supply chains. When chip shortages hit the automotive industry several years ago, entire factories stopped because manufacturers could not obtain relatively simple semiconductors worth only a few dollars. Companies learned a painful lesson. The cheapest chip can become the most expensive component in the world if its absence stops a $50,000 vehicle from being completed. That experience encourages customers to book more production capacity and diversify suppliers. SMIC said customer bookings have strengthened across several industries. For the company, this can create longer visibility into demand, but the strategy is not risk-free. The first danger is overexpansion. Semiconductor shortages can disappear surprisingly quickly. Factories take years to build. If SMIC expands capacity based on today's shortage and demand normalizes before those facilities are fully utilized, margins could fall again. This happened before. SMIC spent heavily expanding capacity even as industry oversupply pressured profitability. Capital expenditure reached roughly $7.3 billion in both 2023 and 2024, while gross margin had previously fallen from above 30% to around 20%. The second risk is geopolitics. Export restrictions remain a moving target. The the United States continues tightening controls around advanced semiconductor equipment and chips connected to Chinese companies. Just this week, U.S. lawmakers again called for stronger enforcement to prevent advanced chips from reaching sanctioned Chinese firms. Further restrictions on semiconductor equipment, spare parts, software, or technical support could make SMIC's expansion more difficult. The third risk is domestic competition. China is investing heavily across the semiconductor industry. More domestic foundries are adding capacity. If too many factories chase the same mature node demand, the current shortage could eventually turn back into oversupply. That would push prices and margins down again. So SMIC must use today's strong demand carefully. It needs enough new capacity to satisfy customers, but not so much that the company destroys its own pricing power later. The broader lesson is bigger than SMIC. The AI boom is reshaping the semiconductor. The obvious winners sell GPUs. The less obvious winners manufacture the thousands of ordinary chips required to build everything surrounding those GPUs. Power systems, networking hardware, smartphones, industrial machines, automobiles, data centers. All of them require semiconductors. And when global capacity becomes constrained, even older manufacturing technology can suddenly become extremely profitable. SMIC's latest quarter proves that a company does not need to lead the technological frontier to benefit from AI. It needs capacity in the right place at the right time. China's semiconductor strategy was originally built around catching up with foreign technology, but for SMIC, the immediate opportunity may be much simpler. While the world fights over the most advanced chips, China's largest foundry is making billions producing the enormous number of less glamorous chips the AI economy still cannot function without. And right now, those factories are almost full.